Hey everyone, Bob Kendall here. Just want to thank you all for watching my videos. If you do want to support the channel, go to www.kendallreport.com/wavetech. Sign up for our software. You get market grid on 165 individual stocks and indices. You also will get 16,500 buy and sell signals on our entire database. I thank you so much for supporting the channel. Those of you who have already signed up, thank you so much. Welcome everyone to the Kendall Report, where I share my 41 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on yesterday's action, notice how the rhetoric around the stimulus deal is having less and less impact. And most of the impact that we saw on a positive yesterday was due to the numbers that I've been focusing you in on, which are the claims and the continuing claims. The claims dropped by 55,000 to 787,000, and the continuing claims dropped well below that 10 million level that I talked about yesterday, down to the 8.3 level. And this is after California fixed all the reporting issues that they had over the past 6 to 8 weeks. So this number was somewhat skewed, and it looks like the California numbers helped, not hurt. As I've been discussing over the past several months, as California and some of these other states continue to come online, that continuing number is going to drop significantly, indicating that the economy is coming more and more back online. What it means fundamentally is that we're likely to see some sort of expansion start late in the fourth quarter to early next year. Now, in the technical section here in a few minutes, today's Friday, so the close is going to be significant from the viewpoint of our database and the model activity that we're likely to see, as well as the actual technical pattern that's setting up for next week. I'll go through all the details here in a minute, but we did see a substantial amount of buys come out of yesterday's rally. The other thing that I discussed in yesterday's video was, will the key support hold that I've been talking about? And that support is down at 3404, down to the 3398 level. We printed in the cash market down to 3415 level. As we go forward, this level will continue to be a serious pivot zone in the market. Also today, we have 50 companies reporting. One of the features yesterday was Intel just got crushed on their reports as that company continues to struggle. Now, the biggest story yesterday, we saw the S&P 0.5, NASDAQ 0.2, but the Russell was up 1.7%, and this was major. And this is related to another event as well, which is the move in the 10-year Treasury to 0.85. I've been talking about that these higher yields are going to make it better for the financial sector, and there's a lot of mid-cap and small-cap stocks in that financial sector. The regional banks and other financial institutions, I believe these higher yields are benefiting this asset class. I will show you the spread charts in a minute, and this thing is very close to starting to break out. And as I've said over the past several months, for the markets to move sharply higher, we're going to need the participation of the small caps and the mid cap asset classes to really get this market moving forward. Let's go ahead and take a look at the charts and see how the end of the week is setting up. As we review the WaveTech database, as I mentioned in the opening comments, there were about 570 new buy signals, only 150 sell signals, giving us a bullish ratio on one of the models and a neutral ratio on the shorter term 1.2 model. But the overall effects of this was to raise the bullish percent back to 34.46 from 32% in yesterday's run. As I've been discussing over the past several weeks, we still need to see this database move over 42% bullish to signal any type of sustainable rally. We're continuing to be locked in a very tight range, and until we see some more positive rotation in the short-term database, the markets are not likely to move away from the current configuration. As we begin the review of the S&P 500 futures, we continue to be in this very tight sideways range for the entire week, as the market has moved just below the 10-period moving average for the last 4 sessions, and we've remained above the bottom end of the moving averages at the 34.15 level. In yesterday's action, we did see the 21 period moving average tested and the market bounced to stay above this support level. However, as we look at the PPMs, we're still seeing an acceleration to the downside of the 10 period moving average, which suggests the cap on the futures will be around the 34.64 level. That also is in line with the R1, R2 level on the grid at 34.60 to 34.72. That is going to be the higher end of the range for today. Most likely we'll see the bottom end is 34.38, so we're looking at an S1, R2 extreme today. As we look at the SPX, in yesterday's action, we traded just above the 21 period moving average, which was at 34.1421 with a low of 34.15.34. Market bounced off of there to close at 34.53, but as I mentioned in the opening comments, we're seeing a less and less reaction to the rhetoric around this stimulus deal. We're now seeing terms, we're getting closer. If you recall, on Tuesday was the deadline. Now we're getting closer. Friday was then supposed to be the deadline. So we'll come into Friday. We'll see what happens. I continue to believe that there will not be a deal. But even if there is a deal now, I don't think anyone's going to really care because it's all priced in, everything right now. There will have to be something much bigger than a stimulus deal. Even if they pass it, it's going to be 4, 6, 8 weeks before any monies hit the street. Also, as I mentioned in the opening commentary, is that we're seeing that continuing claims number come down. I suspect it will be between 5 and 6 million over the next several weeks. So that number will get very lean, and then at that point will be where we'll start to see some reevaluation of the economy that actually will make sense. With today being a weekly close, we really have seen a very narrow range this week. The high was 35.02, the low 34.15. So we're seeing a contraction of the volatility a bit here. We're likely to see on Sunday night when we update the market grid for the week. My expectation is that we will see it contract just a little bit. As we review the PPMs, you'll see that the PPM1 is below its first and second derivative. It's still right at trend level, indicating that there is enough support to hold this market. That number is 34.05. As I mentioned a minute ago, we had a low of 34.15 yesterday, and this is going to be the key support. If we do break through 34.05, then we're heading right to the levels I mentioned last night, 33.42 down to the 32.92 levels. So expect to see that type of decline if that happens. At the moment, the probability to close under 34.05 is only 40%. Next market I'll cover is the NASDAQ. As we've been seeing, it has been drifting since we got that RXT sell back on October 12th. We've just seen a continuing drifting, and we've drifted down into the same pattern where we're trading in between the moving averages 21 and the 10-day moving averages, which right now are 11,309 with the 10-period moving average at 11,512. And so we're continuing to trade in this very quiet sideways range. As we look back just on how the market traded this week, it is actually one of the lower volatility weeks that we've seen for a while. As I review the NASDAQ weekly, the key number here is 11,458, and that suggests that we're going to have major support there. The low has been 11,511, so we're quite a bit above that. That is the 10-week moving average. We also will notice on the PPMs that PPM1 is a 0.47, PPM2 a 0.94, and PPM3 a 0.64. And these are very robust uptrend numbers. So as far as any major declines happening from this level, it is minimal at this time. The probabilities, as in the S&P, are only a 40% probability to close under 11,458. Next, I want to review the Russell-NASDAQ spread that I was talking about in opening comments. We're seeing this long basing period, and we're finally at the point where this spread is going to break out. I've been suggesting for months now, going back to around July is when I thought this trade was ready to put on, where you would be long the Russell, short the NASDAQ. This will be a major trade. Small and mid-cap asset classes start to come more into vogue as folks start to look for stocks that haven't moved yet. I believe that the higher end tech stocks will continue to stay somewhat out of favor. Not saying they're going to decline a lot, but they're not going to have the same momentum that they had prior to September 9th, where we finally started to see basically a shockwave come into the tech stocks. Next market I'll cover is the Russell. The Russell has signaled an RXT sell signal, which suggests that we could get 2 to 3 days down. If you're not familiar with that signal, it's when the market closes above the extreme level on the market grid. Yesterday, the RXT was 1627. Market closed at 1630.25. This just tells us that we're likely to trade toward the bottom end of the market grid range, which suggests we are likely to see at least an S2, S3 level, which would be 1619 to 1614. The extreme is 1609. Typically, we will get at least 2 days, possibly 3. As we saw in the NASDAQ a minute ago, we've actually been declining for about 9 trading days now since that RXT sell on the NASDAQ. We just get this drifting. So it'd be interesting to see how this pattern sets up. PPM2 is actually exploding out of this pattern. It does appear that we're starting to see some upward trend acceleration, but PPM1 is still very flat, which tells us that we're likely to move back toward the 21 period moving average, which was at 1581, but is moving higher by about 10 handles per week. So that'll be 1590, 94 as we come into Monday's action. In this section, I'm going to cover the 10-year Treasury and the US dollar together, because I believe these are very related, and I've talked about this over the past several days. But we did see somewhat of an aberration yesterday as the dollar found a bid. As we look at the 10-year, she closed above its RXT number at 840 at 848. So this is actually telling us we could see a little softness for a couple days here. But more importantly, the solid line up here is the 200-day moving average, and we are getting above that level, which is significant. The weekly chart reveals something similar. We're closing above the 40-week moving average, but we're seeing this sharp acceleration, and down at the bottom here, PPM3 is still negative, but about to cut through its first and second derivative, and ultimately we're going to see the 10-year move toward around the 1%, maybe 1.05 over the next couple weeks. As we look at the dollar overall has been weak, even though it saw a reasonably strong day yesterday. We look at the weekly charts, you can see we traded down to the RXT number, so we're just bouncing off the weekly lows. It's not like there's a real rally happening in the dollar. It is likely to stay stable, and that 93.28 number, which is the 10-week moving average, still looks like it's going to be basically a magnet pulling this market back up toward this range. I don't see a full out collapse out of this pattern, especially with the PPM 1 and 2 in the positions that they are in. The final market that I'll cover tonight is gold. Looking at the weekly gold chart, we still remain sandwiched in between that 21-week moving average and the 10-week moving average. The 21-week is 1888. The low this week's been 1894, which was actually printed yesterday. The high so far this week has been 1936, and the 10-period moving average is 1928. And you also look and see that R1, R2 are right in this range as well, as we saw a R2 at 1937.50. So we traded within the primary ranges of the support level and the resistance. We've been trading in this range now for 4 weeks. We've been locked in this range. As the moving average converged the weekly ranges have went along with that. So I believe we're coiling into a point where we're going to try to break out. 2 days ago, we got a nice signal on the daily, but we faded right back into the range. This weekly chart's going to have to do a lot more work. What will have to happen is that PPM1 will need to move up at least to a neutral level around a minus 0.10. Right now it's minus 0.22. We're going to see this continue, and then when we get a crossover of the first derivative, that will be a sign that gold is setting up for a bigger rally. For now, major support 1888, resistance 1928 seems to be the story, certainly as we finish this week. This will complete the video. Thank you so much for another great week. I really appreciate everybody watching the channel and supporting us through software and other things that we are offering out to the public. So thank you again. Have a great weekend. We'll see you on Sunday night.